Many companies today still add back stock-based compensation expense. As an investor, you should look at these companies and wonder. Most larger firms now include this expense, but many small companies and emerging tech companies still try to get away with this. For example, Google tried to exclude this number until Q4 of 2016. This means Google would show operating income without stock-based compensation expense. When Google changed this, Facebook soon followed. They were some of the last big tech companies to catch up to reality, but companies like Twitter and Snapchat are still adding it back, and many smaller companies who are less scrutinized also try to do it. Here is an example of a small company, Manitex. The difference between now and pre-2005 is now companies only show it under non-GAAP, not GAAP. GAAP means generally accepted accounting principles. Non-GAAP is what management can show investors what they believe is a better way to show its net income. Non-GAAP is often better than GAAP, so don't make the mistake in believing we are against non-GAAP. Just this one of adding back stock-based compensation expense is a very egregious error. Our advice would be buyer beware, or caveat emptor, when you decide to trust management's non-GAAP. Unless you're a trained professional, you should rely mostly on the GAAP figure, as this is standardized across companies. But why are many companies still doing this? They are doing it because prior to 2005, companies were able to officially show their results without stock-based compensation expense counting. But why did an accounting relic that started in the 1970s persist for so long? Before we look at the history, let us know what you think in the comments. Is paying someone in stock or with stock options the same as paying them in cash? What do you think the difference is? Before 1972, stock option accounting was not much discussed. The 1972 rule said that you only needed to recognize a cost if you issued stock above the current market price. For example, if a stock option allowed a person to buy the stock at 40 and the current price was 50, then they would need to recognize a $10 expense. Therefore, most stock options did not have a value and they were not reported. For example, right now Tesla stock is at $255.58. If I gave you the right to purchase a share at $255.59 for the next 100 years, meaning in 100 years from now you could buy it at that price, would you say that I didn't give you a gift? Well, this was the rule before 2005. Enter Warren Buffett. In his 1985 annual report, Buffett criticized the use of stock options and how they were accounted for. In his 1992 report, he added to this criticism. He said, "The most egregious case of let's not face up to it reality behavior by executives and accountants has occurred in the world of stock options." He added, "The lack of logic is not accidental." Buffett laid out key arguments executives made for stock options, and he then refuted them. Executives who are against stock option accounting argued, "They're hard to value." Buffett responded, "So are stocks, and they have a value." Management then said, "It's issued above the current market price, therefore they don't have a value." Buffett responded, "That clearly still has a value." Management then argued, "There are no dollars leaving the company, therefore it's not an expense." Buffett responded, "Why not pay for everything in stock then?" And he said, "You clearly lose value when you give away your stock." Management then said, "Well, options just aren't an expense." And Buffett responded, "Then what is it?" Finally, in 1993, the Financial Accounting Standards Board, or known by their acronym FASB or FASB, mustered up the courage for a rule change, that stock options had to be valued on day one at their fair value, not the intrinsic value that we talked about above, where a stock option only had value if it was issued at a price under the current market price. So what was the value of owning that right? As we showed above, clearly the value of that Tesla stock option I would give you is not zero, but up until this time, accountants said it was. However, despite the accounting change in 1993, executives then stormed Washington to ask the Senate to stop this rule change. The Senate voted 88-0 against stock option expense. Buffett wrote that this wasn't the first time politicians didn't recognize math. He said in 1897, the legislature changed the number pi from 3.14159 to 3.2. Because of the power of Washington, FASB recommended the change, but did not mandate it. So essentially no companies adopted this change. In 1998, in his annual report, Buffett said, "What if we paid Geico's $190 million of advertising with stock options instead of cash? Would anyone argue that Berkshire had not borne a cost?" Buffett added that management and CEOs should be ashamed of themselves. In 2000, Buffett said only 2 of the 500 S&P 500 companies recognized stock-based compensation expense. The S&P 500 is an index that represents 500 of America's largest companies, meaning essentially no company was properly recognizing compensation expense. However, by 2002, more companies were beginning to say that this was an expense, and they were voluntarily adopting this rule change. Buffett said, "Beware of companies displaying weak accounting. If a company still does not expense options, watch out." In 2003, General Electric, Coca-Cola, and Washington Post, three companies that Buffett has historically held large stock positions in, began reporting share-based compensation as an expense, despite not being required to do so. Furthermore, the collapse of Enron in 2001 symbolically ended the party and symbolized the end of the fast and loose times. Soon, Sarbanes-Oxley was added, which required that auditors and executives evaluate financial controls and increase accountability. Auditors and management now face stiffer penalties if they were found to be violating these codes, which would incentivize them to increase accountability. In 2004, the legislature changed their mind a little bit. They said that stock options were an expense to executives like a CEO, but not to an employee. Buffett lamented that this makes zero literal sense. However, by 2005, Buffett finally won, and stock option expense was becoming mandatory on June 15, 2005, meaning after this year's companies had to show stock option expense in their net income figure. Having a long history of fiction has led to companies to this day still adding back stock compensation expense and showing shareholders this non-GAAP figure and saying that this isn't part of the real company expenses. Because of this, Buffett said in his 2015 annual report, "Wall Street analysts often play their part in this charade, parroting the phony compensation. Maybe the offending analysts don't know any better." Why did this fiction persist for so long, and why does it still persist? As we showed in our video Dividends versus Buybacks, we showed mathematically that buybacks and dividends are the same thing pre-tax, but with the current tax rules, buybacks are better. However, many people in the comments said they prefer dividends. Our question is, why would you prefer $8 over 10? The reason is abstraction. Dividends are a concrete concept, you see the money in the account, while share buyback is a more abstract concept. Because no one gave a good argument in favor of dividends over buybacks, we'll give one good reason why you might prefer a dividend over a buyback. The one reason is, until recently, Schwab, Robinhood, E-Trade, TD, Ameritrade charged money for commissions, meaning you couldn't really sell small amounts of stock commission-free. Therefore, in many cases, buybacks and dividends may have the same scenario as an individual investor. In this video, we showed the math showing that buybacks were better than dividends. But what does the math show for stock option expense versus a cash expense? Guys, I hope you enjoyed the video. If you do, please remember to hit the like button and subscribe to the channel. Also, feel free to tune out now if you do not want to see the math on why stock option expense and paying for things with cash are exactly the same thing. Let's start the math. Okay, so let's go through the value of two companies. We'll call the one on the left cash company, so they pay employees in cash. The one on the right, the stock compensation company. So they're going to pay employees in stock compensation. We're going to use a couple of concepts that we cover in other videos. Here are the couple of links. We discuss what a discount rate is in the dividend versus stock buyback video. And we also discuss how to calculate a growing annuity formula, which is the same way to calculate an annuity formula in this video here. So please check them out if you're confused. So we're going to choose a theoretical company with a forecasted earnings of $500. Discount rate is 10%, meaning the total value based on an annuity formula, we're assuming no growth, is $5,000. The beginning shares outstanding is 1,000, therefore each share is worth $5 a share. For the stock-based compensation company, it's also going to be $500. Discount rate is 10%, therefore the total value is 5,000. The beginning shares outstanding 1,000, so everything's the same. Now we start the year. Both companies have sales of 1,000, they're the exact same company, but the first one pays them their salaries in cash. So the net income is $500, we're just going to assume no taxes for simplicity. So the earnings per share is 50 cents. The second one, they're going to give their employees $500 worth of stock compensation expense. So their net income is also $500. The beginning shares outstanding is 1,000, so their earnings per share is also 50 cents. So far we look like we're exactly the same company. Here is where it changes a little bit. So the beginning accumulated earnings, because we just started from year 0, the company has had no cash. It earned net income of 500. We're just going to assume 100% cash flow conversion. The ending accumulated earnings is 500. The forecasted earnings, because every year it's forecasted to be 500 as it's an annuity. Therefore, the value at the end of the year is going to be 5,000 plus the cash on hand, because the cash is expected to be paid back as a dividend or buyback. It has the full value. Some people noted in the prior video, dividends versus buybacks, that why would all the cash be counted in the value? The reason is because it's going to be paid out right now as a dividend or a buyback. If a company is just going to be Scrooge McDuck and keep the cash, then yes, you wouldn't count the full cash in your value. But in this case, we set the assumptions that they're going to pay this all in dividends or buybacks at the end of the year. The value with the excess cash is 5,500, shows outstanding 1,000, price per share 5.5. Now we go to the stock compensation company. They're going to have ending excess cash of 1,000 because in addition to their net income, they had a share-based compensation expense of 500. They're both going to have forecasted earnings for future years of 5,000 because stock compensation companies is always going to give $500 a year to their employees in stock compensation as opposed to cash. So the value is actually 6,000 for the stock compensation company, but they have $500 allocated to its employees. So the value to the shareholders is only 5,500. There's 1,000 shares outstanding. Therefore, the value is 5.5. So you can see the value of the shares are going to trade at the exact same price. The next part we go to is the issuance of stock. So the cash company doesn't do any entries because it's not going to give stock compensation. This company is going to give $500 at 5.5 a share, which means that if you do the math, 500 divided by 5.5, that's 90.91 shares they're going to issue. The beginning shares outstanding, 1,000. They issue 90.91. Their ending shares is 1090.91. Okay, so the one on the left, we said you could do a buyback or a dividend. We're going to choose to do a buyback. So this company has excess cash of 500. If you remember, their net income was 500. It was converted completely to cash. The 90.91 is 500 divided by 5.5. Therefore, they could buy back 90.91 shares. The company on the right has excess cash of 1,000. So if you remember, they made net income of 500 and their expenses was all in share compensation expense. So therefore, they have 1,000 of excess cash. The price, the current price of the stock is $5.50. Therefore, the shares repurchased are 181.82. So the beginning shares outstanding are 1,000. They issue 90.91. They buy back 181.8. And look at this, both companies have the exact same ending shares. So the total value before is 6,000, less excess cash paid out, which is 1,000. The ending value is 5,000 for both companies. Both companies have ending shares outstanding of 909. The price per share is 5.5. One thing to note is look at the payout ratio. That's 200% for the company on the right and 100% for the company on the left. So conventional wisdom says the payout ratio is dividend over net income. So the dividend, what is the company's dividend percent, divided by what is their net income. But look at this, the company on the right's at 200%. So this just shows a flaw in how the payout ratio is calculated. So I would suggest first that you should calculate the payout ratio as dividend plus buyback divided by net income. But this shows you should do dividend plus buyback minus stock compensation expense divided by net income. Because it shows that if you get stock compensation expense or if you issue shares for an expense, then a company has more cash and it can more easily rebuy shares. Therefore, you need to subtract it out in order to have an apples to apples comparison. I hope you enjoyed the video. If you did, please leave a like and subscribe to the channel.